Hi folks, my name's Tim, and today I'd like to talk to you a little bit about the state unemployment tax and specifically the calculation. The State Unemployment Tax Act, or SUTA as it's called, is calculated very similarly to FUTA, or the Federal Unemployment Tax Act. But unlike FUTA, SUTA laws and rates vary from state to state. And in some states, both the employer and the employee pay. In addition, individual businesses have what is known as an experience rating, and this will affect their unemployment rate. I took the example of Alaska for my calculation because they tax both the employer and the employee. Now, again, the SUTA rate can vary depending on the employer, so I just chose a rate of 5.2% for the employer. The employee does pay a 0.5% of their income with a ceiling of $34,100 on both of them. So let's take an example of an executive who's getting paid $6,000 a month. In the first quarter, that person has earned $18,000. We multiply this times 0.052, and the employer pays $936 in SUTA taxes for this employee. We take the same $18,000, multiply it times 0.005, and we can see that the employee pays $90 in SUTA taxes. In the second quarter, this gets a little bit interesting. We've already paid SUTA taxes on this $18,000. We've earned another $18,000 for a total of $36,000 in earnings by the middle of the year. Well, there's a $34,100 ceiling on that, so we can see that this amount is above the ceiling. So we take this ceiling, which is the $34,100, subtract out the $18,000 that we have already paid SUTA taxes on, and we get a taxable income for SUTA purposes of $16,100 for the employer. We again multiply it times the same 0.052, and the employer is going to pay $837.20 in the second quarter. We take that same $16,100 down for the employee, multiply it times the same 0.005, and the employee is going to pay $80.50 in state unemployment taxes for that quarter. Now, what actually happens is the employer withholds this from the employee. The employee does not actually write a check.